The stock market is often seen as a vehicle to wealth, attracting millions of people with the promise of high returns. It's a place where fortunes are made, sometimes overnight. But for every success story, there are countless others where investors lose significant sums of money. So, why do people lose money in the stock market? Is it bad luck? Poor timing? Or is there something deeper at play? In this script, we will explore the various reasons why people lose money when investing in the stock market. From emotional decision-making and lack of knowledge to poor risk management and market cycles, we will dive into the core factors that lead to financial losses. Understanding these reasons is essential for anyone looking to navigate the stock market with more success and less risk. Whether you're a beginner or a seasoned investor, this analysis will help you become more aware of the pitfalls and improve your investment strategy. 1. Lack of knowledge and understanding. Overconfidence and ignorance. One of the most common reasons people lose money in the stock market is overconfidence, particularly the overconfidence that comes from a lack of deep knowledge. Many people enter the market thinking that it's as simple as buying low and selling high. The reality is far more complex, and without a solid understanding of market dynamics, investors are bound to make mistakes. Overconfident investors often ignore the importance of research and preparation. They believe that a little information, such as a stock tip from a friend or a news headline, is enough to make an informed decision. This is a dangerous mindset. Investors who skip the learning process or don't understand the companies or industries they're investing in are setting themselves up for failure. B. Failure to do proper research. Research is crucial in investing. The most successful investors, like Warren Buffett, emphasize the importance of understanding the businesses you invest in. This includes looking at financial statements, industry trends, management quality, and the company's future prospects, but many people neglect to do their due diligence. Instead of carefully analyzing a company's fundamentals, they chase hot tips, rumors, or trendy stocks. This leads to poor investment choices. When the stock price inevitably drops, those who didn't understand what they were buying are left with significant losses. C. The dangers of relying on others' advice. It's tempting to rely on others' advice, especially when the stock market is confusing or overwhelming. You might hear your neighbor brag about their profitable investment or see an influencer on social media claiming to have the next big stock. The problem is that these recommendations often come with hidden biases or incomplete information. Investors who rely on these tips without doing their own research risk losing money. This is compounded by the fact that many of these sources are not objective or professional. Advice from friends, family, or influencers is often based on their own personal biases and experience, not on rigorous analysis. Relying on hearsay or speculation instead of education is a surefire way to lose money in the stock market. 2. Emotional decision-making. The role of fear and greed. The two most powerful emotions influencing stock market decisions are fear and greed. These emotions can lead to impulsive actions that ultimately result in financial loss. Fear of missing out, FOMO, is one of the biggest motivators for investors to act irrationally. When you see other people making money in a hot stock, the fear of missing out can push you to buy in at inflated prices, even though the stock is overvalued. You might believe you're getting in on the ground floor, only to watch the stock price crash shortly after you buy. On the flip side, greed can lead investors to chase unrealistically high returns. Greedy investors are often looking for the next big thing that will make them rich overnight. This leads them to take on excessive risks without fully understanding the potential downsides. Greed often blinds investors to the fact that high returns are usually paired with high risks, and this is a recipe for financial loss. B. Panic selling and emotional reactions to market volatility. Emotions also play a major role when the market experiences volatility. When stock prices are falling, fear can drive investors to panic sell, often at the worst possible time. When markets experience downturns, investors who are emotionally tied to their investments often make the mistake of selling at a loss. thinking that they can cut their losses and avoid further pain. This reaction is a fundamental mistake. History shows that market crashes are often followed by rebounds. Investors who sell in a panic lock in their losses and miss out on the recovery. C. Confirmation bias and herd mentality. Confirmation bias is another psychological trap that leads to poor decision-making. Investors who believe they know which stocks will succeed may selectively seek out information that supports their view while ignoring contradicting evidence. This bias prevents investors from seeing the full picture and can result in major financial mistakes. Similarly, the herd mentality, where investors follow the actions of the crowd, can lead to significant losses. When everyone around you is buying into a stock, it can be hard to resist. But this mentality often leads to inflated asset bubbles. Once the bubble bursts, those who follow the crowd without thinking critically end up with massive losses. 3. Timing the market. The myth of market timing. Trying to time the market is one of the most common mistakes investors make. Market timing refers to the attempt to buy low and sell high by predicting the short-term movements of the stock market. While it's theoretically possible to time the market, in practice, it is extremely difficult, if not impossible, to predict the direction of the market with consistent accuracy. Most investors who try to time the market end up buying high during market rallies and selling low during downturns. This behavior is directly tied to emotional decision-making, such as greed during a bull market and fear during a bear market. B. Impact of short-term speculation. Short-term speculation is often mistaken for smart investing, but in reality, it's a risky strategy that frequently leads to losses. The allure of making quick profits from stock price swings is hard to resist, especially with the rise of day trading and online platforms. But short-term speculators are often betting on unpredictable events rather than long-term growth. This speculation can lead to significant losses, especially for those who are unprepared. Even seasoned investors struggle with short-term trading, which often results in higher transaction fees and taxes. C. Failure to understand market cycles. Another factor contributing to poor timing, a lack of understanding of market cycles. The stock market goes through natural cycles of booms and busts, driven by economic, political, and global factors. However, trying to predict exactly when these cycles will occur is nearly impossible. Investors who try to time these cycles often get it wrong. A much safer approach is to invest with a long-term perspective, avoiding the temptation to jump in and out of the market based on short-term trends. 4. Overtrading and lack of patience. A. Churning and frequent buying. Selling. One of the fastest ways to lose money in the stock market is through overtrading, frequent buying and selling of stocks. This can occur for several reasons: excitement, impatience, or the belief that every market fluctuation presents an opportunity. However, overtrading leads to several problems. Transaction costs, including commissions and fees, eat into any potential gains. Moreover, frequent trading can trigger higher tax liabilities. The short-term nature of overtrading also prevents investors from benefiting from the long-term growth potential of their investments. B. Lack of a long-term investment strategy. Many investors fail to develop a long-term investment strategy and instead react to short-term market movements. This lack of patience often leads to underperformance. For example, an investor might panic during a market dip and sell, only to watch the stock price rebound weeks later. Developing a well-thought-out strategy, sticking to it through ups and downs, and having the discipline to hold onto investments over the long term is essential for avoiding unnecessary losses. 5. Poor risk management and diversification. A concentration in one stock or sector. Many people lose money because they concentrate too much of their portfolio in a single stock or sector. This is risky, as any negative news or downturn in that stock or sector can wipe out a large portion of their portfolio. Diversification is a critical principle in investing, as it helps reduce risk by spreading investments across different assets, industries, and geographical regions. B. Lack of diversification. Diversification doesn't just reduce risk, it also helps smooth out returns over time. By holding a mix of stocks, bonds, and other assets, investors are less likely to see their entire portfolio decline during market volatility. A well-diversified portfolio can weather economic downturns and provide more stable long-term returns. C. Ignoring risk tolerance. Investors often make the mistake of ignoring their own risk tolerance when selecting investments. They might take on too much risk in the hopes of high returns, only to panic when the market becomes volatile. It's essential for investors to assess their risk tolerance based on their financial situation, age, and long-term goals, and then build a portfolio that aligns with that tolerance. Conclusion: strategies for avoiding losses. In conclusion, losing money in the stock market is often the result of emotional decision-making, poor risk management, lack of knowledge, and behavioral biases. The key to successful investing lies in understanding these pitfalls and developing a strategy that minimizes risk while maximizing long-term gains. Investors should educate themselves, avoid chasing trends, and diversify their portfolios. They should also resist the temptation to time the market and instead focus on a long-term investment approach. Most importantly, investors should develop the patience to hold investments through both good and bad times, avoiding knee-jerk reactions to market fluctuations. By staying disciplined, diversified, and patient, investors can avoid the common mistakes that lead to significant losses and achieve success in the stock market over time.